Hello bro and welcome back to the new video, man. See, it was such a long time since I made the last video, bro, but you know how it is. I had my family here on the visit, so I wanted to spend as much time as possible with them. After all, family is the most important asset. Nah, I'm joking. After all, family is the most important thing that you can have, you know. So of course I wanted to spend some time with them, okay? And as you might have noticed, I renamed my channel, I rebranded it because I wanted to have it a bit more professional, you know, but still that doesn't change the fact, bro, that we will still have this good old personal approach, you know. I am your mentor, you are my trainee, you know. You know how it goes, bro, like I will teach you, you will teach me something, and together we will see each other on the top of the world, you know. But with that being said, bro, let's go. So today we are going to analyze one insurance company called UnitedHealth Group Incorporated with the stock ticker UNH. And the reason for that is because one of my viewers requested that I start to investigate, you know, that I start to research more and more insurance companies because he is interested in investing into those. So here we are, bro. Sorry for the wait. I know you requested maybe, how much, 2 weeks ago or maybe even 3 weeks ago, I don't know. But here we finally are, okay? And for the analysis of this stock, we are going to use my Excel table as always. And we are going to analyze income statement, balance sheet and cash flow statement. And by doing so, we will follow my rules that I established, okay? And the rules are like this. We will always analyze the last 10 years of financial data because this will give us better perspective of the development of the company, how the company performs and how it might perform in the future, okay? And always when we will analyze the data, we will decide whether we should buy or sell this stock according to the data that we analyze. And ultimately, bro, we will based on the data that we decide if the whole financial statement is marked as buy or sell, okay? And first we will analyze good things and then we will analyze the bad things. And at the end of the video we will do final evaluation where I will give you my opinion whether you should buy or sell or maybe even hold or at least have this stock on a watch list, okay? Now let's go straight into it. So the good news are, bro, that total revenue and gross profit are growing consistently through the last 10 years. You can see that here on the graph. Here you have total revenue, here you have gross profit, and both of them are growing, which is very good sign, okay? And the same thing is also for operating income and net income. They also show quite an amazing growth, okay? And then when we go to balance sheet, you can see that retained earnings are also growing. And this is very important, because retained earnings are earnings that company reinvests back into itself instead of paying it as dividends, okay? And right now here, if the retained earnings are growing, that means that the company is investing more and more money into itself, maybe to expand some businesses or something, and they don't pay that money to the shareholders, you know, so they don't lose that money immediately, okay? This is an extremely important sign. Each good company should do that. Each good company should have retained earnings as high as possible, okay? And here you can also see that return on equity is also well above 10%, okay? Right now it's sitting at 24%, which is absolutely amazing, bro, because this basically means how much profit the company generates, you know, through the whole years, okay? This is very simple concept, okay? And now we come to the cash flow statement, and here you can see that capital expenditure is also growing through the whole years. What does that mean? That means that the company is investing more and more money into buying maybe new plants, new equipment, new machines, new computers, and because they are reinvesting more money into themselves, you know, as capital expenditure says. You can also see that this is connected with retained earnings here, because the more they reinvest back here, the more money they have to reinvest and the less money they have to pay to shareholders, you see? Because the more retained earnings are growing, the less money they pay. And the more retained earnings are growing, the more capital expenditure is also growing. You know what I mean? So this is absolutely amazing, bro. And nonetheless, bro, even though they are investing more and more money, they are still managing to grow dividend payments through the all 10 years that we analyzed here, which is for dividend investor absolutely crazy, bro. This is what we want to see. This is what you want to see if you are a dividend investor, because that means that you will get in the future more and more cash for the same price as it is right now of the stock, okay? And intrinsic value is basically also one very important aspect that we need to analyze. This tells us what would be the fair share price based on cash flows and dividends and all of those complicated calculations in the background, okay? So basically here we can see that the intrinsic value of this stock should be $640, and right now the stock is currently trading at 500 euros approximately, dollars, which gives us a spread between intrinsic value and current value of $150, and that's absolutely crazy, bro, because the stock right now should be valued as this should be the price, and right now it's $150 less. So that's an amazing sign to see, okay? And now unfortunately, bro, we also need to cover the bad things, okay? And the bad things start with gross profit margin and net income margin, okay? Gross profit margin should preferably be always more than 40%, okay? Gross profit margin is basically calculated by dividing gross profit with total revenue. And here you can see that this calculation gives us around 24, 25, 26 even, but it's around 25%, okay? Which is way lower than 40% as we want to see, okay? And the net income margin is also lower than preferably 20%, which is also quite a bad sign, you know? And net income margin is calculated by dividing net income with total revenue. And you can also see here on the graphs, you know, that those margins are way lower than what we want, okay? But still the good thing is that they are kinda slowly growing. At least net income margin is slowly growing, so that's a good sign. But what is another bad sign is capital expenditure divided by net income. We want to see this growing to the all years, because that means, so let's think about it a bit. So capital expenditure means that the company is basically investing money back, and the net income shows us how much income they produce, okay? So if we divide capital expenditure with net income, we basically see how much additional money does each expansion make, okay? So whenever they reinvest money back, how much money can they make out of that? You know what I mean? And preferably, bro, we want to see this growing. And right now here we can see that it's falling. So what does that mean, bro? That means that the more they reinvest back, the less money they get from those reinvestments. And this is a terrible sign, okay? Another bad thing is that the long-term debt and total liabilities are both growing through the years. We obviously don't want to see that. And one very unfortunate thing is that debt to equity ratio is just slightly higher than 60%, okay? Because preferably we want to have debt to equity ratio lower than 50% or at least lower than 60. And here it's just slightly above 60, you know? It was so unfortunate, but what can we do, you know? And the last thing that is kinda bad is P/E ratio in comparison to the top 8 competitors, okay? So here are the P/E ratios from the competitors, which gives us an average of 22 P/E ratio, and the current P/E ratio out of this company is around 30, let's say, which is also higher than the average of the competitors. So here are the 8 competitors, and it's also higher than preferably 15%, not 15%, just 15, what we want to see, you know? Because what does P/E ratio actually mean? So for each dollar that we want to earn with UnitedHealth, we should invest $30. And that's way too much, bro. That's double as much as we would want to see with 50, okay? And now we come to the final decision. And my final decision, bro, is that you should not buy this stock at the moment, but maybe if you are interested in this company, put it on watch list, okay? Because gross profit and net income margins are not that good, you know? As you can see here, they are below 40%, they are below 20%. Although, bro, they seem to be slowly growing, okay? And they are also quite stable. And then new investments seem to bring less money, or at least less income, as you can see here with this ratio. And then they also have just slightly too high debt, more than 60%, and they also have high P/E ratio in comparison to the one from competitors, and the stock itself is also extremely expensive, bro. When I was making this video, it was trading at around $500. That's way too much, bro. You want to have the price of the stock lower than 150 euros, otherwise it's way too expensive. And otherwise, bro, the incomes are also really good. You see total revenue is growing, gross profit is growing, operating income, net income, they are all growing, which is absolutely amazing. Retained earnings are growing, and so on and so on. So they have bad good things, but they also have good things, you know. And also stock dividends are also increasing, which is good for us dividend investors, and they are also reinvesting more and more money back. So here, bro, my head is literally scrambled eggs, you know. For me, I wouldn't buy it because I don't have that nice feeling of it, you know, because it's too expensive. But if you are interested in it, bro, then put it at least on watch list, and then let's wait a bit to see how the company develops, okay? And with that being said, bro, do the hard work and see you on top of the world.